Assalamu alaikum and welcome everyone. My name is Chaudhary Muhammad Aziz Anwar, a chartered accountancy and financial management professional. Today I am pleased to present a topic that is not only critical for accountants but also essential for everyone involved in governance and public administration, understanding public sector financial accountability and statutory requirements. We will take Pakistan as our primary case study while drawing broader relevance for other developing economies. As public finance professionals, understanding how accountability works and why it often fails is vital for improving transparency, efficiency, and trust in government institutions. This presentation will walk you through three interconnected dimensions: the structure of the public sector, its components, and how they function, the meaning and necessity of accountability in financial reporting and governance, the key laws and statutory frameworks that safeguard financial discipline. We will conclude by connecting these components to understand the big picture of public accountability. This knowledge not only helps auditors and public servants but also empowers citizens and professionals to demand better governance. Public financial accountability refers to the obligation of public institutions to account for their fiscal decisions and performance. It is the cornerstone of transparency, democracy, and efficient service delivery. Without financial accountability, even well-designed policies can fail. In Pakistan and many other countries, challenges like corruption, inefficiencies, and weak institution control undermine service delivery. By embedding accountability in law and practice, governments can restore public trust and redirect resources toward genuine development goals. Let's now examine the five key components of Pakistan's public sector. Government ministries. These include the Ministry of Finance, Health, Education, responsible for policy, resource allocation, and interdepartmental coordination. Statutory bodies. Institutions like FBR, SECP perform specialized regulatory or developmental tasks under specific laws. Public enterprises. These are companies owned and operated by the state, like Wabida, Pakistan Railway, and PIA, that provide utilities, transport, and other services. Local authorities. These include union councils, municipal bodies, and district governments that address the local needs of citizens, waste management, water supply, roads, and education. Regulatory authorities. Independent bodies like NEPRA and PEMRA that ensure rules are followed within specific industries. Collectively, these components handle trillions of rupees in public funds every year. Each of these components has a distinct but interrelated role in financial governance. Ministries develop macro-level policies and annual budgets aligned with national priorities. Statutory bodies ensure the rules of the game are followed, whether it's collecting taxes or regulating stock markets. Local governments are closest to the public and often handle funds for education, sanitation, and local infrastructure. Public enterprises must manage operational efficiency while balancing social responsibilities. Regulators ensure market fairness, tariff rationalization, and service quality. A well-functioning public financial system requires all these parts to communicate, coordinate, and comply with shared standards. Accountability is public finance means being answerable for how public resources are raised, managed, and spent. It requires public officials to follow established rules and procedures, maintain transparency through disclosures, justify performance and explain variances, accept scrutiny from audit bodies and public. Accountability also fosters ethical behavior, ensuring funds reach their intended purposes, whether it's a school, hospital, or road projects. The importance of accountability cannot be overstated. It promotes public trust by reducing corruption and promoting openness. Fiscal discipline, which is essential when resources are limited. Legislative oversight, allowing elected representatives to question misuse of funds. Value for money, ensuring efficiency in every rupee spent. It also ensures that citizens through their taxes are not shortchanged. Every rupee misused is a school not built or a patient not treated. The cost of poor accountability is immense. Here are just few examples. Ghost employees inflate the government payroll, draining resources. Overpriced or non-existent projects divert funds from real development. Fake invoices and missing documentation make audits unreliable. Inadequate checks lead to unchecked corruption at various levels. These failures result not just financial losses but also in the erosion of public trust, affecting investor confidence, donor rate, and governance credibility. Let's now review the main laws and instruments that form the backbone of financial governance in Pakistan. The Constitution, Article 7884, provides the basis for public funds, including the Consolidated Fund and Public Account. Public Finance Management Act 2019, a modern law ensuring performance-based budgeting and financial control. Auditor General Ordinance 2001 empowers the AGP to audit all public accounts and ensure compliances. NAB Ordinance 1999 empowers anti-corruption investigations into public financial mismanagement. PPRA Rule 2004. These guide transparent procurement and contracting across all public entities. Together, these instruments aim to prevent misuse and promote fiscal discipline. How do these laws translate into practical safeguards? Standardized accounting codes allow uniform reporting and analysis. Sealing on expenditures prevent departments from overspending. Real-time reconciliations between spending agencies and treasuries ensure funds flow integrity. Audits and parliamentary reviews highlight gaps and recommend improvements. In theory and in practice, these laws ensure that every rupee is accounted for and every deviation is traceable. Accountability is attained through a four-pillar process. Reports. Ministry must submit regular reports detailing expenditures and results. Oversight. Institutions like PAC review these reports every year. Audits. Conducted by the Auditor General who flags non-compliance, inefficiency, and fraud. Reforms. These findings then inform policies and procedural reforms. This is the cyclic model of governance. Observe, evaluate, improve, and repeat. All three pillars, components, law, and accountability mechanisms are interdependent. Law provides the rules of the game. Components implement policies and manage funds. Accountability mechanisms review their performance and enforce compliances. If any of these parts fail, the entire system risks collapse. That's why integration and communication across departments and institutions are so crucial. Let's summarize these relationships visually. Financial resources begins with budget allocations by ministries, then flow to department and local bodies. These are governed by statutory laws, tracked through financial reports, and examined by oversight bodies like PAC and Auditor Journal. This generates corrective feedback leading to reforms. The ultimate goal: improved governance, better service delivery, and public trust. To conclude, public sector financial accountability is not just a bureaucratic obligation, it is essential for democratic governance, economic stability, and national development. As accounting and finance professionals, our role extends beyond compliance. We act as stewards of public trust, protectors of financial integrity, and advocates for transparency. By upholding strong accountability system, we can ensure that public resources achieve public good, whether it's in health, education, or infrastructure. Thank you so much for your intention. I hope this session has helped deepen your understanding of how financial accountability and statutory frameworks operate within the public sector, particularly in Pakistani context. Should you have any question or comments, I welcome your engagement. Let's work together to build a system that delivers value, transparency, and trust.